Right now, a strange idea is gaining traction. The crashing the stock market might somehow help America's $35 trillion debt load. Lower bond yields mean lower interest payments on the debt. So if the market falls, bond prices rise, yields drop, then Trump or whoever's in office can refinance the debt at a lower rate. Seems simple, right? Well, not really, because that's not how the national debt works. Let's unpack this with some facts, some finance, and some simple English. When you refinance your mortgage, you're taking advantage of lower rates to pay less interest over time. But the US debt doesn't work like that. Instead, the US Treasury issues bonds with a set coupon rate. That's the annual interest that they're willing to pay on borrowing that money. These bonds have a set duration that can be from months to decades, but most of them aren't callable, which means once they're out into circulation, the government is obligated to continue paying them until maturity, or the date that they're due. You can't simply call up bondholders and say, I want to renegotiate that rate. They're not callable at all. So if you issued a 30-year bond at 1.5% in 2021, that bond is on the books until 2051, and you will continue to pay that rate. Let's look at a real quick simplified example. Imagine the US issued a 1-year bond for $100 at a 1% interest rate. If it was bought at par, that means you're giving the government $100 or the owner of that bond $100, and at the end of a year, you get $101. After it's been issued, the government is obligated to return that capital plus that set amount of interest. They will always pay out $101. But let's say that interest rates have changed and the current holder of that bond wants to sell it. They might sell it at a different price. Maybe they decide because the rate environment has changed, instead of selling it to me for $100, they're going to sell it to me for $100.50. This now means that when I get paid out the $101 from the government, I've only made a 50-cent profit. This means the ask yield of the bond is 0.5%. That ask yield of the bond is the bond rate that we see reported in the markets. That doesn't mean that the government is paying any less. Now, it might impact the rate of the new debt that they issue when things are turning over to maturity, but they're not able to replace that on all of the debt that's already out in circulation. It also doesn't necessarily mean that the prime rate has come down. Right now, for example, the Federal Reserve is not interested in cutting rates even though the bond rates have come down because of the fear of that remaining inflation. So while with a change in rates, you might be able to refinance your mortgage at a better opportunity, the government doesn't get to do that in the same way. And because in the ZIRP era, when rates were near zero, the government issued a lot of long-term debt. That means that the government's interest rate on its debt is actually very low and has been lower than the average bond rates for quite some time. In fact, the average US interest rate right now paid on the federal debt is only 3.32%. That means if we did want the rates to drop enough that it's going to impact the average interest paid on our debt load, we would need the rates to absolutely crater. And how much of that debt are we actually talking about refinancing? People like to throw around the total debt, the $35 trillion, as if we're refinancing all of that. The reality is that apart from these short-term duration assets that were already coming up for maturity renewal, who had high coupon rates under the high inflation regime and are coming down, there's only an additional $3 trillion of debt coming up to maturity that could be reissued at a different rate. So right now, if the bond rates are at the 4.5% and we want to chop that down to 3.32% just to match the average government rate on interest and not even lower it, that would only save us about $35 billion in interest a year. Meanwhile, our annual interest right now is $1.6 trillion. Even then, it might sound like $35 billion a year, adds up. That's a lot of money that could be used for other things. And it's kind of true, but right now we've nuked the market by $5 trillion of value without any change in the actual prime rate, as the Fed is not ready to cut. And that $5 trillion of value lost in the market, if that was taxed, even as capital gains, we're talking between $100 billion and $500 billion in tax revenue, depending on how long those assets had been and what write-offs are against it. And that doesn't begin to get into the fact that these tariffs are going to slow spending, cause layoffs, slow income, and overall lower the tax revenue that the US is able to make. So we crashed the market by $5 trillion, we've lost about $500 billion in taxable revenue, alienated our friends, made life more expensive for us, and not had any impact on the national debt. Bond rates, especially on the 10, 20, and 30 year, are set by the bond market. They are the expectations of inflation, growth, and investor demand. The prime rate is what impacts short-term borrowing, credit cards, and small business loans. And you can't force bond rates lower. Even when the Fed slashes rates, if it's doing so as a reaction to a bad economic condition, investors may begin to lose confidence in the US markets. And at the end of the day, the bonds are the full faith and credit of the US government. And when we have volatile policy decisions that do not make economic sense and are damaging to the market and our trade relationships, we have to begin to worry about the faith and credit of the United States government for the first time in history. So the next time somebody tells you that we should be crashing the market to refinance the US debt, you can ask them which number they think is bigger, $5.5 trillion or $35 billion, because that's how the math on this works out. At the end of the day, the solution to the US national debt is fixing our spending priorities and closing revenue loopholes that allow trillions of dollars to be nested overseas, not paying their fair share into the economic economy of America, which they take advantage of. That's not about taxing people more. That's not about taxing companies more or taxing the uber wealthy at some crazy rate. That's about companies and people cheating the system and not paying the fair share for the services they use and are provided with every day. And that's a way we can help address the ever-growing debt in this country without destroying the economy in the process.